Good morning.
I think we should focus on the mission.
Good morning, folks. This is Miguel. Mr. Wilkinson is having some difficulties trying to log on. So give him a few minutes. I'm trying to work it out with him right now, okay?
Good morning, all. So we only missing Mr. Wilkinson, eh?
Yes, good morning. I trying to get, he's having some problems logging in. I don't know why. Um,
Oh,
yeah, so I trying to wait to see if I can get him logged on. I don't know if he has no internet at home or if something's wrong with the internet at his place. But yeah, he's trying to get on.
okay.
Hello, can everybody hear me? Hello.
Yes, good morning. We can hear you.
Good morning. I'm so sorry about the delay. I don't know what happened, some techno something somewhere. And I just had to rely on, I don't know, intuition or something, because I normally should just be able to launch the meeting like you guys and go right in. That was not working for some reason. So I had to go through the back door somewhere and come up with some blah, blah, blah. And then eventually it worked for some reason. I hope I could remember what I did next week. But I hope Miguel and company can sort whatever that may have been. I have no idea. I just seem to have gotten lucky today romping around. How is everybody?
I'm
I'm
good.
okay.
Just happy that you're finally here.
That makes all of us, actually. I was wondering what the hell, hoping I didn't have to not have this session today because of all the techno mumbo jumbo. Okay, so let me just do my register before we begin, to see who's here with us. Natasha,
Good morning.
good morning. Owen,
Morning, sir.
good morning, good morning. Ashley,
Good morning.
Ashley,
Hi, I'm here.
oh, there you are, Ashley. Okay. Okay, Akaria, Akaria,
Curia here.
okay, there you go. Fabienne, okay. Cheryl,
Here.
okay, lovely, lovely. Mm-hmm. Urbanette,
Here.
okay, lovely. Michelle,
Here.
perfect, perfect. Dion,
Dion should be shortly. She was running late, so she told me to convey that. She should be here
okay,
shortly.
okay, perfect. Thank you very much. And Indira, Indira, hmm. Okay, so a couple of housekeeping points before we get into chapter. What is that today? What are we studying today? What topic is it?
Chapter 10?
What topic is that?
Depreciation.
Long-term
Long-term assets.
Long-term
Long-term
assets?
assets.
Is it long-term assets?
Depreciations of long-term
Long-term
assets.
assets.
Hmm.
It says long-term asset, but it also has depreciation inside the chapter, I'm guessing.
Okay, actually, that's not really the chapter I wanted you to look at. I thought I'd mentioned liabilities last week. I didn't say that. Long-term liability.
Long-term assets is our next chapter.
So long-term liabilities is in chapter 11.
No, it's long-term assets is in chapter 10. That is
Where-
what.
where-
Chapter
Where-
11 is current liabilities and fair value accounting.
Yeah, that's the chapter that I really wanted you to look at first. But that's okay. We can do the lecture from my text, and we'll just do long-term assets next week, because we only have 3 more sessions left. Actually, 10, 11, and 12 already. We're already in week number what again? Anybody knows? What week is this today?
This 11?
Yeah, this is week number 11. That means we have 3 more weeks left, including final examination. I've been looking at the homework pieces. The homework has been, for the most part, pretty good. And where folks may have gone off here and there, but nothing major. And so I'm hoping that you're finding that helpful along with your reading. Your final exam will not be a hell of a lot different from your homework assignments. That's why I've labeled you with them so that I can give you an opportunity to do even better by getting the practice, because that practice is designed to help you come exam time. Like I said, for the most part, most persons are on the right path. I've seen a couple of people struggling to balance the reconciliation. Not too many people, but they're just off by one transaction or maybe a transaction here and there. But basically, they understand which way. Okay. The postings in the general ledger accounts that people have been doing look very professional, even though some of them are like, I'm not drawing any straight lines, I have to go. But at the end of the day, the material and the information in those individual accounts in the ledger um, are done fairly well. So I'm happy to see that you guys look like little professionals already doing this crazy stuff. And for all of those persons who took the time, not only will you get credit for the work you did for your homework in terms of the overall 10% assignment, but also you will get the benefit of practice. In accounting, like many other things in sports and otherwise, it's all about practice, right? And so if you're feeling burdened, that's okay. That's the intention. That's designed to make you a little bit better at the end of the day. Because reading is important, but you have to actually do it as well. Okay, so way to go.
Sir, I have a
Yes,
question, please.
sure.
Two questions actually. How
Mm-hmm.
would we know our position in the class thus far? And then my next question is that I know you had said we were going to do face-to-face for the final midterm.
What
How
final
would that
exam?
work? Final exam, how would that work for the COVID cases rising? Would that be revisited?
Kiss my foot. That story with the COVID cases rising is true?
Yes. You
No,
have
no, no.
some schools have been closed for only virtual for a few weeks.
So we're back to that madness again.
Well, as long as the room is large enough for us to distance
Uh,
ourselves,
yeah,
we'll be
yeah,
fine.
yeah. That's a good point, but it is large enough, and and since it's only 8 or 9 of my students, you guys should not have any difficulty. You will not be in each other's faces for sure. There's more than enough room. So if you do have that concern, I don't think you have to worry about that. You will have adequate spacing, and the institute will have the necessary. What is all that stuff you keep putting on our hands again?
Sanitizers.
Yeah, the necessary sanitation and all that stuff for you for the 2.5 hours or so or 3 hours that you're there. Okay, so unless something major happens and we do have physical lockdowns and all that, you should be fine. Okay, you should be fine for sure. All right.
What about the position in terms of the standings, where we are at in terms of the class at
Yeah,
this time?
I actually, for some reason, I'm usually better at getting my grades out to the students. For some reason, this one has been delayed for no fault of your own. All kinds of other interesting things happening. I won't make any excuses from them. Just say crap happens, third wave and whatever. That's not the reason either. So I I'm I if since you asked that question, um, obviously once you get your results from your midterm, and most persons have done reasonably well for a first time examination. I'm hoping to be able to send you that assessment today. And since you raised that, I'll give you some indication of that aspect of it, along with whatever your grade is, and some indication of what you have to do on an individual basis. Okay, so that's my plan for this weekend, so that um, after that you have a fair idea of what you're going into your final examination um, with, so to speak. Let me say this for all of you who have submitted your homework. Um, Technically, there's a 10% allocation for your homework. So if you submitted all your homework, you're going to get the full 10%. I'm not particularly concerned that you got a few points wrong. That's not the real thing. From what I can see, most persons have been pretty much following the text and doing it correctly. That's my real concern. That's what I want to see. So if you've submitted all of your homework, you're more than likely going to get the full credit. If you haven't submitted all, you miss one or two, instead of getting 10, you're going to get 8 out of 10, that kind of thing. Okay, so you can gauge where you are with that. If you've attended your classes basically every week, you know you're going to get full credit for that. For persons who may have missed one or two, you can probably get 8 out of 10, 9 out of 10, depending on how many sessions you missed. That's how I'm going to do those two things, along with the final assessment that I'll give you on your midterm exam. So I'll kind of lock them in together and give you an idea of what you look like in 3 weeks going into your final. Okay, so you should know that sometime this weekend altogether. What I will say is keep doing the homework, keep doing your reviews, keep doing the homework, keep doing your reviews. Even go back and look at one or two things again. Keep practicing. That's the key. Because the more you practice it, even if you go back and redo the homework, because the more you practice it, the better you're going to be final exam. Because final exam questions are going to be very similar to homework. It's not going to be a big secret like gotcha. If you've done your homework, you shouldn't have a whole lot of problems in your final exam in a couple of weeks. Seriously. So you may be quote unquote suffering a little bit now with all that madness, but it should benefit you at the end of the day. Right?
Mr. Wilkinson,
Yes.
I wasn't quite comfortable with one of those homework problems.
Which one was that, Carol?
That's problem P1 with the depreciation.
Depreciation.
Oh, sorry. Sorry. No. The age receivables and so forth.
Oh, the age receivable.
Yes.
Okay.
Maybe we can go with that at some point at the end of the class.
Let me make a note of that. Age receivable. Okay, Cheryl, just so I can think about it, what did you have, where did you get stuck, so to speak?
Okay. The first part of it had us to analyze the information and put them in two T journals and so forth. When we had to, we had to calculate the receivables. One was the percentage.
Right.
That's the percentage portion of it.
Okay. You got kind of stumped you.
Yeah.
Okay. All right. We'll have a look at that. So we can see where you may have gotten stuck. And that happens. Students get stuck on that all the time. It's not unusual. So we'll have a look later on and see if we can pull that stopper out so you don't get stuck on that one.
That's one of the disadvantages of the homework. If I make a slight error, I don't know what the error is without a feedback.
Well, what made you feel that you didn't do it right?
I just wasn't comfortable doing it. It could be right, could be, I don't know. That's just it.
Oh, you just had that thing. I know that. It looks like it's okay, but you're wondering if it's okay.
Yes.
Yeah, okay. No problem. As a matter of fact, what I'll do, Cheryl, is I will look at your question in particular, And then based on what I see, I will get back to you and see if I can pull out that little knot for you.
Okay, thank you.
Okay? Whatever that might be. All right, great stuff. Okay. One other piece of housekeeping that I need to mention is I think we were saying that the final exam date is May the 29th. Is that what you guys have?
Yes.
But if we go back and look at it, we have 4 more sessions, including today, which means that our final exam should actually be a week before the 29th, if I'm not mistaken. Do I have a second? Do I have a second? I'm saying May the 22nd. Is anybody else who agrees or disagrees with that?
We would have covered all of the remaining 3 chapters, I
Well,
guess.
we're in week number 11 today, which is May the 1st, and so we have
This
3
week
weeks
is
left.
10. Okay.
No, this today is week 11, which means that after
I
today,
think that took away because we didn't do practically anything on the first week, eh? We started chapter 1 perhaps in the second week because everybody didn't have their books.
well, yeah, I know, but we're still on schedule with
Okay.
the material. I just wanted to make sure that we're on the same page with the final exam date, which if today is May the 1st and we're in week 11. That means we have 3 more weeks after today, which would be May the 22nd. I just need somebody to confirm that 3 weeks from today is May the 22nd on your calendar.
It's the first 1, 2. If you said it's on the 22nd final exam, so it will be 2 weeks after the day. We'll have 2 more classes and then final exams.
Right. So altogether, it's 3 weeks from today that we
Yeah.
have left, which means that final exam will be on May the 22nd. Is
Yes,
everybody?
if that's what you say.
I need a second. No second. Hmm. So the final exam date then is May the 22nd. Okay. Just please make a note of that, because I think we were saying initially a couple of sessions ago it would be May the 29th. And again, maybe somebody was counting like beginning week 2. In the introductions, we still have all the material that we need to cover, and so we include week 1 as well. All right, so please make a note of that. If you have the 29th, please change that to May the 22nd. All right. Okay. Let me see if I can get this screen up. Hmm. Crazy today. All right. So if you guys can turn to your current liabilities in your text, I think for you that's chapter what? 11? Or before you go there, let's go back to the previous chapter. What chapter did we do last week?
We did chapter 9.
Chapter 9. Ended just before that. get you to turn pages and mash up that new book a little bit. Did we discuss notes receivable?
I guess not, because I don't recall discussing it.
No, we didn't.
No, I think we ended just before that.
No, I don't think we did.
All right. So where is notes receivable in your textbook? Is it chapter 9 or chapter 8? Okay. And that begins on what page?
337.
337. All right, so let's go there for a moment. I want to take the first few moments to talk about one or two important concepts um, in this particular chapter, and then we move on to current liabilities. Again, remember, as we go, you can raise any question you want about what we're talking about or anything else about what we're not talking about. Okay, so feel free to do that at any time. Interrupt me any time if you think of something that you think is important to you. All right. So a promissory note. Somebody's still moving something, I think. Okay, a promissory note. Can somebody tell me what that is? Ever heard that word? Promissory note. Anyone?
It's a promise that you're gonna pay the money back or whatever it is that you got.
Yeah. What's another name for God?
Borrowed.
Yeah, borrow. Remember that word? Yes, that
Mhm.
dirty word called borrow. Well, it's not all that dirty, but uh yeah, it's a promise to repay. If any of you have ever had a bank loan, excuse me 1 second.
Could somebody please tell me what chapter we're dealing with, please?
We on 337.
Thank you.
Okay, if anybody's ever borrowed from the bank before, they would ask you to sign a document promising to pay. That's a promissory note, means you owe them money. They expect to be paid on the terms and conditions on that promissory note. In the world of business, notes receivable occur because business people sign IOUs as well, similar to a promissory note, promising that they will pay you. And when they do that, your accountants have to set up a notes receivable account in the general ledger. So nice you guys actually understand this lingo already. That's good. In the general ledger, so that you can have a record in your accounts about what is owing. Believe it or not, there's still some people who are not recording transactions, and sometimes they don't remember what they have or don't have. They're walking around with it in their head. You say, "Did you have any loans?" Oh, let me see. I don't think so. Then you check. Oh, that one, and all this stuff. And if you're recording stuff in your records, you don't have to remember. It'll be there until forever and ever, and certainly until you pay it off. All right. So the notes receivable is when somebody owes you. A notes payable, obviously, is what?
When you owe them.
Absolutely, whether an individual or a company. That's the point. What are the three forms of business that we discussed previously that was in your test?
Sole proprietor, partnership, and corporation.
Okay. It looks like everybody trying hard to get that right. I think that had a correct rate of maybe 95%, and I was happy to see that. Some people still got stuck on the difference between managerial accounting and financial accounting, that one is for internal information, one is for external users. Most people still did okay. Some people kind of forgot that. So it's looking good. Even some of the big time questions with the financial statements and postings and all that. Some persons did a very good job, and since I'm grading them one by one, it's a lot of bits and pieces to tick off to see if we did it right, to see if we used the correct expressions. So it tends to take a while to make sure all of that information that you're given credit for the correct information. So the way I grade accounting is that for every correct entry you make, if you have to do journal entries or postings or whatever the case may be, For every one you do correctly, you get 1 point. And for every one you miss, you lose a point. Okay, so I give you credit not necessarily just for the answer, but I give you credit for the process. That for every journal entry you do correctly, you get credit. Every posting you do correctly, you get credit. Every trial balance and the item that you do correctly on the debit side and credit side, you get credit. So I'm not just looking for the total and says, the total is wrong, the whole thing is wrong. Okay, I don't do that. You only get wrong what is wrong, and you get credit for what's right. Okay, so that method that I use, unfortunately, too, takes a little while to get through, but I find it's very effective, especially to reward you for the details and the process that you go through to do that stuff. All right. Then I don't know if your text has a little example of a promissory note, does it?
Yes.
Okay. Yeah, I was trying to share my screen, but maybe because of the back door that I came through, it doesn't allow me to do that. I don't know what the hell I did to get in. I'm just happy about it. So yeah, if you look at the promissory note, you can see, for those of you who've never had a bank loan before, that's kind of an idea what you will sign your life away in the future. That signature at the bottom is you. Uh, if you're doing it for somebody who's borrowing from you, then you become the maker. If you're borrowing the money, then you become the borrower. And then you can see very clearly what the details are, the amount, the dates, and what's important. Okay, and every promissory note basically should have that information. Okay. Also, every promissory note has a maturity date. I hope you've read this by now, so you know what I mean. Um, some maturity dates are specific, like it's due on the 14th of November. Some maturity dates say, after a couple of months it's due, and then some other ones say it's due in 60 days or 90 days or whatever the case might be. In any event, if it's any of those specifications, it's still a maturity date. It still means that you have to pay it on that date. What we want to look at for accounting purposes is making sure that we come up with the correct number of days. Because remember, the interest payments are based on the number of days. So if you don't do it properly, you may end up paying more or less interest than you should. And so coming up with these days are important. Did anybody have any problems with the first example on May 20 due in 90 days? Would be due on August 16. Anybody any problems with that?
You mean
Calculating.
with the work?
No, in the example, do you have an example where they show you how to calculate the number of days?
For notes receivable?
Yeah, under maturity date.
Excuse me, Mr. Wilkinson.
Yes.
I may have to leave the class early this morning.
How early?
I can't say. I have a tragedy in my family, and when my brother comes, I will just exit.
Oh my goodness. I'm sorry to hear that, Owen.
Yes, sir.
What to do is when you settle down a little bit, please send me an email and ask me for the homework, and I'll give it to you.
Thank you, sir.
Okay. As, like my grandmother used to say, when it's not one thing, it's the other thing. Very tragic, Owen.
Very.
Oh my God. Just what I need to hear. More bad news. Okay, not a problem at all, Owen. Not a problem at all. Just when things settle down, just drop me a note so I can send you the homework.
All right, sir.
All right. So, does everybody see the maturity date information in your text, like how to calculate the number of days?
Well, we have the maturity date on the promissory note, but we don't see the calculation.
The calculation is on 346.
Yeah, 346. Where it says the total, how to get the total number of days. Your example is 90 days?
Yes.
Yeah, 90 days.
Yeah.
The important thing to remember for this particular maturity date, if you'll see from your reading, is that it is important to exclude the date of the note. So in other words, if the date of the note is May the 20th, you cannot include that in counting the days. If you do, it'll be wrong, 1 day off. Okay, that's all I can say about that. It's pretty straightforward. That's the only thing you need to remember. Do not include the date of the note. Okay, so if you get a homework question or a test question, if you include the date of the note, you're going to get the wrong answer. All right, so in this case, the note is dated May the 20th. Do not use that date in calculating the number of days. And once you do that, you'll see the remaining days in May would be 11. June has 30 days, July has 31 days. And to get it to 90 days, it's 18 days in August. And that's basically how we calculate the number of days for the note. Okay, that's what you need to keep in mind. All right. And then we have a slightly different example where we have the duration of a note. So in this example, the actual duration of the note is 92 days, and you want to figure out, okay, if it's 92 days, how do we go about establishing when the note is due? And in this example, again, if the date of the note is May the 10th, we do not include the date of the note. We just include the remaining 21 days in May, excluding the date of the note, and then June 30th, 30 days, July 31 days, and then to get it to 92 days, it ends August the 10th, and you will see that that is actually the maturity date. Okay? May not seem very significant now, but later on in calculating interest, you have to get the exact number of days. Otherwise, you will end up paying a little more money than you should, or receiving a little more money from somebody who owes you interest than you should if those days are not correct. You have to check that. Okay? And remember, if it's a couple of $1,000, it may not be a big problem, but if it gets into the millions, 1 day could be a lot of money. Okay? All right. I hope everybody knows how to calculate simple interest by now. If not, just a reminder, principal times rate times time equals interest. All right. If you still have to learn that, that's it. No problem. Go ahead and learn it, because you'll see it again later, and it's very important for your personal life as well. When you go to borrow money, to make sure that interest calculations are correct. It's nice to know. So whatever your banker says, they might be right, but nothing wrong with double checking them, because sometimes they're wrong. Okay. What is maturity value? Well, maturity value is simply what you borrowed plus whatever interest you paid or received. And so in this example, at $1,000, you can see that the principal is 1,000. The interest rate is 8%. That's why we have 8 over 100 times how many days? Anyone?
90 days.
Yeah, 90 days divided by 365 days of the year. So this note is basically running for how many months?
3.
3 months.
Absolutely. And if you do that math correctly, and I always encourage students when you're studying reading, the book is usually right, but still do it so that you get practice doing it. Okay. And I think I assigned homework on this so you can practice, because it's very important in terms of calculating interest that you expected to receive or interest you have to pay. Right? And you oftentimes don't find out how critical this is until it starts affecting your pocketbook. So it's a nice thing to know. So in this example, the principal is $1,000. How much is the interest?
$19.73.
Absolutely. So the maturity value on this note would be $1,019.73. Okay. All right. Not difficult. You just have to work it. Just make sure you understand the basic principles. All right. Anybody ever heard about accruals or accrued interest or accrued anything in their life?
Yes.
Yeah. When you hear accrual, what do you think about?
You are putting monies up at a time until the actual payment is due.
Okay, that's kind of warm. That's one concept. Yeah, and the other
Monies,
concept, uh-huh.
would it be monies earned but that hasn't been received as yet?
Okay, that's even warmer. Yeah, that would be like accrued income. And then, of course, accrued expenses would be monies owed but not yet.
Received,
Accrued expenses would be money owed but not yet.
oh, not paid, sorry.
Paid,
Very,
paid.
very, very good. Very important concept to remember in accounting and in general. All right. For example, if you work overtime for a week and the payroll has already gone through, then there will be an accrued expense for the company because they owe you money, correct?
Yes.
So what the company will do is set up an expense for what they owe you, and then set up a payable account, a liability account, salaries payable, to show that they owe you for a week's pay or for overtime. And then when the next payday roll around, then they will include that in the paycheck and then reduce the liability once they pay you. That's what accruals are all about. Okay. It's either an amount that you owe but you haven't paid, or an amount that is due to you that you haven't received. Okay. Very good. All right. So keep that in mind because we're going to see accruals later on. I think your textbook gives a very simple example um, about how an accrual works. For example, assume that the $1,000 90-day 8% note that we saw earlier was received on August 31st, and that the fiscal year ended September 30th. In this case, 30 days interest, or $6.58, would be earned for the first 30 days. So you accrue it, even though it's a 90-day note. If the year ends September 30th, which would mean that the note is only outstanding for 30 days, so you have to accrue interest for 30 days. But the full thing will be paid when? In 90 days. Okay? So that's how accruals work. Okay? Did anybody get stuck on that reading that little example that they gave? Because if you did, that's okay. We'll see it again a little later. What is a dishonored note?
Notes
What is
not
it?
paid at the maturity.
Yeah, somebody says they'll pay you in 90 days, and then the 91st day shows up and they don't pay you. That's a dishonored note. Okay, they didn't honor their commitment to pay you as agreed. All right. Okay, so that's all. That's all for the notes receivable. It's a very short bit of information, but it's very important for business and very important for your personal life. All right. Okay. So let's move into current liabilities then and see what part of your accounting life that is all about. We all know that a liability is an amount that we owe. We all know by now that under the classified balance sheet, for example, we have current and long-term assets, and then we have current and long-term liabilities. So that's who we are now on the current liability side. So let's see why
So,
it's
Mr.
running.
Wilkinson, we'll be
Yes.
skipping chapter 10.
We're not skipping it. We're just doing current liabilities today, and then we go back to chapter 10, which is assets next week. So we're not skipping it. Okay. It's just that I want to do current liabilities first, and then we'll do assets next week, and then the final week we'll do partnerships. Okay, so good question, but we're not skipping. I assume by skipping you mean we're not doing it at all.
Yeah.
No, we're gonna do it next week. I just want you to introduce you to the liability side so you can be thinking about how to manage what you have to pay. Because most of us manage the asset side pretty well. It's the liability side that we get stumped on. Like, what do we have to pay and why? Okay? All right. The crazy thing, if you've read, well, most of you probably have not read current liabilities yet. But the crazy thing about liabilities is that it is an amount or amounts that you owe as a company, And so you have to always be watching what you owe, because remember, when things go bad, pandemics kick in, economies start to shrink for whatever reason, the more money you owe, the more difficult it'll be for the company to survive, or even an individual. Also, you cannot determine your true net worth until you take out what you owe. So if you have a house that's worth $200,000 and you owe the bank and some other people $170,000, then you don't really own $200,000 in assets. Your net worth becomes what? Anyone? If your house is worth 200,000 and you owe 170,000, what is your net worth?
You said 300,000 minus 100,000?
No, your house is worth 200,000, your asset.
Uh-huh.
You owe your liabilities 170,000. What is your net worth?
Balance that. Ew.
30,
Repeat the question again,
30,000.
please.
Your house is worth 200,000, your asset. Your liabilities, including the loan to the bank for the house, is 170,000. What is your net worth?
30,000.
$30,000. Okay. So the reason why liabilities are so important to keep to the forefront, you have to always be aware of what you owe, because at the end of the day, when push comes to shove, you have to clear what you owe before you could say what you own. Okay. In fact, some people have liabilities that exceed their assets, so they don't own anything. As a matter of fact, they're in a deficit position. So if they sell off everything and pay off all the liabilities, they still owe, which is a position no company or no person wants to be in. But many companies and many people are in, unfortunately. Okay. The idea is to get your liabilities or your debts paid sufficiently so that one day you get rid of all of them, God forbid. That's possible. And if you can't get rid of all of them, at least try to keep paying them down until, if you have to liquidate, sell some of your assets to get out of a mess. You lost your job, you got sick, whatever the reason, you got old. You can sell off your assets, pay off your debts, and still have some money left in the bank, and go down to Inago and sit down, say the hell with it, or whatever. Okay? And companies must be thinking this way as well, because if their debts get too big and something happens and the creditors say we want our money now, that company will have to sell off all its assets, pay off its debts, and sometimes they don't have anything left for anybody else. All right? So current liability is not just to make you miserable. That's the whole point. It's something you need to be aware of if you're in business and if you're even alive. Okay? So do you have the Nike example in your text? In the discussion about liquidity, do you have the Nike in your text? Where we were talking about managing liquidity and cash flows.
Liquidity and cash flow.
Liquidity and cash flows.
Chapter 11, right?
Yes, for you guys. I wish I could share this screen. Do you see anything that says under current liabilities, managing liquidity and cash flows? I hope they didn't leave that out. That's very important. Nobody sees it?
I don't see Nike as yet.
Okay. Well, when you get into the deep dive, if they have the Nike example, you'll see that actually what they're doing is comparing working capital amounts and ratios By the way, a lot of people did pretty well in the ratio question. And one or two people fell off the edge as usual. That's normal. But most people remembered that current ratio is what? What's the formula? The current ratio. Anybody remembers? No?
Current asset divided by current liability.
Yes. Current assets divided by current liabilities. Simple as that. What about even the more simpler ratio? Working capital. What's the formula for that? Working capital. It's so simple, it's ridiculous. Anybody remember?
Current asset minus current liability.
Absolutely. Simple as that. And remember, these two ratios are really, and again, we're studying companies, merchandising companies, and business in general. But this stuff, even though we don't do this in our personal lives, because most of the time, like we don't even know what it is. But uh, but if you even apply it to your personal life, it's really looking at whatever current assets the company has on its balance sheet, and then looking at the current liabilities, what it owes. And the reason why companies have to keep looking at this, and many companies don't do it, and therefore they end up in trouble, is that they have to keep looking to see if they have enough money to do what? Enough money to do what?
Pay bills, unexpected, current bills and unexpected bills.
Yeah, expected and unexpected, just like everybody else in the real world, just like us individually. Those of us who are not watching what we have to pay, we're gonna end up in trouble and have to borrow, beg, steal, embezzle, all kind of stuff to pay liabilities because we're not making enough money or we're not checking to see what we owe, and so on, or the amount of money we're actually borrowing, so that we don't get so indebted that we get stuck. Happens all the time. All right, so those ratios are not just there to like take you back to grade school to do math, like arithmetic. They are very simple, but they are very important once you understand how to use them and why. All right, so how do we evaluate our accounts payable? And what are accounts payable? Liabilities. Okay. Now, your text should show you the first ratio that we use in accounting to evaluate accounts payable. Okay. That first ratio is called payables turnover. Anybody seen that? It should be sitting right there, I hope. Anybody see that?
It's on page 433.
Yeah, page 433. Okay. Payables turnover. That's why we did all the ratios earlier, because ratios keep coming. Remember, in accounting, everything builds on the other thing. We're just studying individual concepts about important topical issues. But we're always going to see transactions. We're always going to see journal entries. We're always going to see general ledger accounts. We're always going to see ratios. That's why I bothered to bother and put you through all that homework thing, because you're always going to see these basic things. For those of you who do sign up for accounting too, which I encourage you to do, you'll see these fundamentals never go away. It's like the ABC of accounting. All right. So if you really want to, I think I mentioned it before. If you really want to solidify your understanding of accounting, you would have done a lot of that by the end of this semester. I encourage you, whether or not you're planning to go on to become a CPA or any other professional accountant of any kind, I always encourage students to do at least the first two accounting classes, because they really do give you a very strong foundation. Right? And I also always encourage students to do it back to back if possible. Do not wait another year or two. That usually means you won't do it. And if you eventually get to doing it, you have to remember, like, what is the accounting equation again? Because it's so far back in your mind. Okay? If you can, do it right away. That's what I would encourage you to do. Do everything except steal the money, but do it. It's a good idea. All right. So what is the formula for the payables turnover? Anyone? The formula for payables turnover. On that page that she mentioned.
It is cost of goods sold,
Mm-hmm.
like plus or minus change
Mm-hmm.
in the merchandise inventory
Yes.
divided by average accounts payable.
Yes. Now, what do we learn about averages, period, whether it's assets or liabilities? How do we calculate average again?
Beginning and ending.
And then
Right,
divided by
right, too.
2.
Way to go. Some of you will find that simple average to be very important to use and to help in coming up with stuff later on, whether you realize it now or not. All right. Plus or minus change in inventory. All that means in terms of change in inventory is if you started off with 10,000 and ended up with 8,000 and you have a minus position. If you start off with 10,000 and end up with 15,000 and end up with a plus position, that's all that means. Okay, so whatever that is at the end of the year, you add it to cost of goods sold or subtract it from cost of goods sold and then divide it by the average. And so in this example, the payables turnover becomes 3.7 times or almost 4. We'll see in a minute what that means. I just want you to see the formula first. But then formula shouldn't be new to you guys now because you've done all kinds of formulas and ratios. Okay? The other measurement that we use for payables is something we call days payable. And as you can see, once you calculate the first one, which is payables turnover, days payable becomes a very simple formula, 365 days in a year divided by the turnover that you did previously, and that gives us a days payable of 98.6 days. Now, what does all of this mean, these ratios? Well, they usually indicate that what we call the provisions for credit terms. In other words, they tell us how long it takes for the company to pay back its current liabilities. In this case, 98.6 days, and that in any particular accounting period, which is usually 1 year, this happens 3 to 4 times a year, which makes sense. Because, for example, if the days payable is 98 days, that's roughly every what? 98 days. Yeah, great, fantastic. Roughly every 3 months. And if the actual payables turnover is 3.7 or roughly almost 4, then how many quarters are there in the year? How many 3-month periods are there in the year?
4.
4. So roughly you can see that the days payable is roughly correct because given the 98 days to pay back and we turn over almost 4 times a year. All right, so roughly that's we can see from that discussion that these ratios are correct. Okay, so the payback period for Nike in this example is roughly every 30 days. Okay, and so they do that roughly 3 or 4 times a year. And it's important for companies to have this information so they can determine, okay, do we have the money to pay this thing back when the 98 days roll around or the 90 days? If we don't have the money, where are we going to get it from to pay our creditors, whoever they might be, whether it's the bank or vendor, whatever the case might be. And so it may have to be you have to get a temporary overdraft facility. It may have to be that you have to go into cash reserves to pay it. It may have to be that you have to go on some selling campaign to get some inventory sold off to get the money. Whatever it is, this information is designed to help you make decisions. And of course, the persons who do best in making decisions are those who have access to information. And that goes for your personal life too. It's hard to make good decisions if you don't have access to information. Okay? So if you're planning to marry somebody and you don't have any access to who they are, you might find yourself in big trouble after you walk down the aisle. because you made a decision based on no information or insufficient. Come to find out, you married a serial killer, male or female, or wife beater, male or female. And so on. And so in business, it's the same thing. If you don't have information, you may find yourself making improper decisions that could be devastating to the companies. And companies are known to do that. That's why we see some are failing and some are succeeding. And all too often, it has to do with the information. And all too often, it has to do with how we manage debt, which are payables. Debt, which are payables. All right. So you guys getting the heads up. For some of you, might be like, wow. For others, it might be, I know that I just need to go and manage my debt better, which are the same kinds of things companies need to be saying on a daily basis as well. All right. How do we value liabilities? No problem. Whatever your promissory note says you have to pay, that's your liability. That's what you put on the books. Not a big problem. Classification, we have current and long term. I believe we know now that current means that it has to be paid within 1 year, and long term means that the liability will go for more than 1 year, whether it's 2, 10, 15, 20, or 30 years. I think we know that by now. Also, liabilities have to be disclosed when necessary as notes to the financial statements. You'll see that when you get a little bit more in accounting too. But it's important that remember the balance sheet, income statement, for example, only have numbers on them. Any information that is important to those numbers, you have to put as a note to the financial statement. Okay, that's what we mean by disclosure and accounting. Right? So if your company borrowed $300,000 and you show that on your long-term liabilities, you have to make some important information in your notes by saying we borrowed it from First Caribbean International Bank. The interest rate is this, the maturity is that. Put the details in the notes so that whoever's reading that financial statement will not be left in the dark. And some companies don't do that. They just put the number in 300,000 loan, nothing else. Loan from where? For how long? At what interest rate? And so on. So you can see any reader of the financial statements would want to know that. So you have to disclose it. And believe it or not, some companies are still trying to get around it. Okay? All right. So, has anybody come across the expression in that chapter called definitely determinable liabilities? Definitely determinable liabilities. DDL. Anybody? Shouldn't be too far down under those ratios.
Page 412.
Yes. Okay. For those of you who are still stuck, page 412. All right. Thank you very much. And by definition, what do we say that DDL is?
Current liabilities that are set by contract or statute and that can be measured exactly are called definitely determinable liabilities.
Yes, they are set by contract. So if you make a contract with a vendor, an individual, another company, a bank, a credit union, whatever, and you sign that contract, that promissory note, that note to receivable, payable, whatever, you are bound by that contract by law or statute. Statute we know means law. All right. So if it's a contract or a law that requires it, then you know that that liability is determinable. There's no way to get out of it. You must comply with it. It's going to happen, and therefore it should appear on your balance sheet. Don't try to leave it off and act like you didn't remember because you didn't want to show it. You don't want your shareholders or others to see you have an additional loan. Just like some of us when we go to borrow money from the banks. Do you have any other loans? So what do we say?
No.
No. Why do you think we say that?
To increase the chances of you getting the money.
I'm glad somebody actually was honest about it because we, don't like want to say it. But yes, thank you for saying it so clearly and so plainly to increase our chances of getting the loan. Okay? Because we know that sometimes if we say that we have other loans, the bank might say you cannot afford this one. And we might decide in our minds as a borrower we need this loan dead bad for whatever reason. So we like twist the truth a little bit. We say we don't, or we outright lie. So we don't have any other debts. Companies do the same thing. If they have to borrow a significant amount of money, they may not want their shareholders to know they're borrowing money. Because remember, every time the company borrows more money, it goes against the assets of the company, reduces the shareholders' equity, and shareholders don't want any of that. Correct? If you're an investor, you don't want to hear that your company's borrowing left, right, and center. You don't have any sense. If you are part of society paying taxes, you don't want to hear that your government is borrowing left, right, and center, putting the country in more and more debt. But we know that these are the things that are happening everywhere in the world, Bahamas included. Okay. So yeah, so we just lie and say we don't have any other commitments. The problem is this doggone credit bureau. How is that going to put a damper on things? Will we be able to lie in the future after the bureau comes on?
No.
No, because the credit bureau is currently collecting information now, and everybody who have loans in the Bahamas from all the banks and putting it into their database. So soon in the very near future, maybe by the end of this year, all of our outstanding loans everywhere will be in the credit union database, and then they will assign credit ratings and numbers to that information. And whenever you go to borrow in the future, the lending institution will contact the credit bureau for two things: to give them information that you're borrowing and to find out what your credit score is to see if you're eligible to borrow any more money. And the credit bureau will say yes or no. If they say no, you will not be able to borrow. If they say yes, your credit score is sufficient for you to borrow, then you will be able to borrow. So for some Bahamians and some banks and lenders, that's a fabulous thing. And for some other people, that's going to be a nightmare for them because their helter-skelter borrowing days will be over. Sadly, some people are going to be hurt by it because of what we used to do in the past. And lenders and others will say, this is great. Now people can't get away with lying anymore. They can only borrow what they can afford to borrow. If you need anything else for school fees, too bad. Go steal it from somewhere, borrow it from somebody, uh, take your children out of private school, whatever the case is going to be. So it's going to be interesting in case you were not thinking about that because of the corona thing. Okay? All right, but for you youngsters coming up, that's going to be a very important change in your lives as well. And a lot of people are still not aware of the credit bureau, of the fact that it's coming soon, and of the implications it will have on your ability to borrow and manage your debt. All right. Bank loans and commercial paper, these are kinds of payables. We know what bank loans are. Borrow money, you have to pay it back. Commercial paper is usually a paper that is signed by big companies. If they need a couple of $1 million quickly, they'll go into an investment bank and say, we need a couple of $1 million for 90 days. Do you have anybody who's prepared to lend it unsecured? And the investment banker will go out and find somebody who's prepared to lend it unsecured at a very big fat interest rate to make money. And because the company is a reputable company who's borrowing it using on the commercial paper, they will lend it unsecured and make some big bucks in 30, 60, or 90 days or more on the deal. Okay? In any event, whatever we call it, it's a debt, it's a liability, and it has to be accounted for. Okay? All right. So the first big time payable that we want to look at is the note payable. Do you see that in your text? The example with the note payable, the journal entry again, and the posting. Anybody sees that? If you see it, just say, I see it.
Yes, I
I
see
see
it.
it, page 4112.
Yeah, 412. All right. Now notice the example in this particular question. How much is being borrowed in this example?
16,000.
16,000? Okay, that sounds like something down the line. Let's see if that's the one I want. Okay, so let's say if 16,000 is in your text, that's fine. So you're borrowing $16,000. So what journal entry would you make?
Debit cash for 16 and then credits notes payable for 16.
Okay, and what notation would you make on that journal entry?
Issue 60 days, 3% promissory note.
60 days, 3% promissory note. Yes. Now, my text is 10,000, 60 days, 12%, but that's okay. I'm happy that happened because now you see it doesn't have to be the same each time. So I'm saying 60 days, 12% promissory note in my text. You're saying 60 days, 16,000, 3%, and hey, that's fine. The entry is the same. Debit cash, credit notes payable, make your notation. Did they give you an example of a note?
Yes.
Yes, so you see that note again, 60 days after the date I promised to pay. How much?
16,000
That's
with the
right,
interest of 3%.
absolutely. And whose signature is that? Yours, or whoever's borrowing. So you can't say it was not me. So now you have a promissory note. So the 60 days pass, you have to pay it back. What journal entry do you make to pay it back? Or when you pay it back, what journal entry do you make when you pay it back? In 60 days.
Debit note payable
No
and credit
payable, credit
cash.
cash.
Aha.
And
Now,
also interest expense as well for the
you debit note
yeah.
payable for 16,000, and then you debit interest expense for whatever that works out to be, and then you credit cash for the maturity total, correct? Which is principal plus?
Interest.
Yes.
Yes. See that stuff we looked at early in maturity, and now it's come back again. That's why you have to know these things. All right. So what is the interest expense in your example?
$78.90.
How did you get that?
And that's the 16 times the 3% times the 60 days.
Yes. 60 over?
365.
Yes. And 3% over?
100.
My. All right, so we're back to calculating simple interest as well. So don't discount any of that previous stuff. That's why when you first go to grade school, they tell you the first thing we will learn is our alphabet. Because once you learn that, it never changes and you always need it. This is the same thing. Once you learn the simple interest calculation, you always need it. So I don't need that. You always need it. I'm not going to be in business. That's okay. You need it for you personally. That's the beauty of this accounting thing, is not just for business practices. A lot of this stuff you guys need in your personal life, whether you realize it or not. And the more you understand it, the more you can function. Okay. All right. So we debit notes payable for the principal, we debit interest expense for the interest, and we credit cash for the full amount. And we make a notation. And so that's a very simple example of how to account for notes payable. When you get it, when you pay it. All right. Now, during the process of getting a note and paying a note, sometimes we have an accrual that occurs because the company's year end comes around before the full period for the note to be paid. So, for example, you would see in your text, do you see accrued liabilities right under that note example? I hope they have it there.
Yes.
It's
Page
there.
414.
Yeah. So how much does your tax accrue for?
$39.45.
$39.45.
Yeah.
Okay. How did you get that? How did we get the $39.45?
It's a 16 times 3 over 100 times 30 over 365.
Aha. Now, what's the full maturity date of this note? Just scroll up a little, you'll see.
60
It's from the
days.
original. Yeah, 60 days. Absolutely. But even though it's 60 days, the company's financial year comes up before the note matures. Does everybody see that? And so,
Yes.
and so at the end of the company's year, which you'll see if you read it, only 30 days of the 60 days have passed. So the full maturity date has not yet come, but the financial year has come. So you have to show how much interest the company owes from the day you got that note, 30 days before, to the end of the financial year, which in this example is 30 days. That works out to be $39 and how much?
45 cents.
45 cents. So even though the note has not matured yet, 30 days has come up as at the end of the financial year. You have to show what is due up to the end of the year, which is $39.45. And what journal entry will we make at the end of the year to show that accrual?
Credit interest payable and debit interest
Interest
expense.
expense.
Absolutely. Debit interest expense for the calculated interest, and credit interest payable because you owe it, you just haven't paid it yet, right? Correct?
Correct.
When will you
Correct.
pay it? When will you pay it?
At the end of the 60
Out of the
days?
30 days.
Or
Yeah, at the end of the 60 days, which is another
30
Month.
30,
days.
yeah, 30 days or so from the end of the year. So you see how this adjustment works. Okay, so you're beginning to get this accounting thing. So when somebody says it's month and a year and you're trying to make adjusting entries and we're trying to make sure all the transactions are accounted for, this is what accountants are doing. Okay, in this case, they say what do we have in liabilities? How much interest is accrued as at the end of the year? Because we know that we don't pay this until next year, but we have to accrue whatever is due in interest expense as at the end of the current accounting period. Okay? If you don't do that, your accounting records will be incorrect. Okay? That's why you have to actually learn this stuff like you guys are doing it. Okay? So that you can make sure that the accounting records are correct. If you don't know these principles, you're not going to be able to apply them properly, and the financial statements will not be correctly stated. It's as simple as that. All right, so that's how accruals work. Okay, and then 30 days later, when it's paid, what do? You just do what? Debit interest expense for the remaining 30 days and credit the full payment, which is the previous 30 days plus the current 30 days.
Or some people, they reverse the previous accrued amount and just record the full amount.
Yes, they do sometimes. That is an option. That will not be incorrect either. Okay, absolutely. All right, and again, some different companies have different policies, but either method is correct. All right, let's look at a couple of other payables. So we've looked at note payable so far, accrued liabilities, dividends payable, same thing. If dividends are
So,
calculated,
I have a question, please, based on what you
yeah,
just spoke about just now, right?
yes,
So, at the end of the 30 days, because that was the end of the bank or whatever fiscal year, we would
right,
have made this journal entry of interest payable and interest expense. But in essence, the client
doesn't pay this until the end of his 60-day is expired.
Correct.
Okay.
Very
So
good.
at the end of his 60 days, we would pay the 16,000 plus his interest.
Yes.
Okay.
Way to go. Okay. Thank you for making that clear to yourself and everybody else. That's exactly how we look at it. And that's exactly why you need to understand it. Okay. So you can do exactly what you just said and do it correctly. Way to go. Doggone it. Man, this is great. All right. Dividends payable, same thing. If you decided to pay dividends to your shareholders, $5 million for some reason, you had a great year, you accrue the $5 million as a dividends expense and you credit dividends payable, same thing. And then next year, whenever the board says to pay, you pay it. But you have to accrue it until you pay it. Okay? You have to accrue it until you pay it. All right. Some companies, they don't do the accrual. They just say, well, we're paying it next year and then make an entry when you pay it. That's
But
a cash.
wouldn't
Sorry.
the dividends come from revenue? Why would it
Yes,
have to be accrued if it's coming from revenue?
it's because anytime you have to pay something you don't pay until you pay it, it's an accrual, no matter where it's coming from. In this case, it's just dividends coming from revenue, but until you pay it, you have to show it. Let me give you another example. If you're paying $5 million in dividends from revenue for this year, correct?
Okay.
But you're not paying it to the shareholders until next year. You still have to show it as dividends expense this year. Does that make sense?
No, because I thought that the revenue, the funds sit in the revenue account until the company decides to invest it or to make use of it. Am I
That's
correct?
that's retained earnings. That's the part that the company keeps. Remember, dividends is the part of
Oh,
revenue that the company pays to shareholders.
okay.
Yes. I'm glad you mentioned that. Get that sorted out in your mind. Remember, when the company makes net profits, it goes to retained earnings, correct?
Yes.
Now, once it gets to retained earnings, the company has two choices: keep all in the business for future operations, or pay some to shareholders who are waiting for dividends because they put their money in your company and keep the rest in the company. Most of the times, it's both. Pay some to shareholders to keep them happy, because if you don't, when you need money from them again, they're not going to put it in your business. You follow that? Just like the bank paying interest. If you go to the bank with their CD and they say, we're not paying any interest, they give me my money. I'm going to the credit union. Correct? It's the same thing. All right. So whenever companies make profits, it all goes into the business, but some of it goes out to shareholders or owners as dividends. And so we say that that is the dividend expense that we account for at the end of the year, and then we pay it usually the following year. Okay. All right. Thank you for bringing that up, because a lot of people get a little stuck on that one. Okay. So that's tax.
Yes.
Okay. What is the total sales tax in your text? What is the total sales tax in your text? How much you have to pay in cash?
230.
Yeah, $230. So what happens when you look at this? Something simple happens. They tell you, for example, a merchant makes a $200 sale. That's that is subject to an 5% sales tax and a 10% excise tax. These are just all government taxes like VAT. I'm sure we've all heard about VAT because we're paying VAT every day on everything, it seems. All right. When you pay VAT to the company, that VAT portion is not the company's money. Whose money is that?
Government.
Yeah. So that VAT is equivalent to the sales tax in countries like the United States and Canada and the UK. Okay? In case you wondered. Now, so the sale is 200. What is 8% of 200? Sorry, 5% of 200. Yes, you do need a calculator. 5% of 200. How much is that?
$10.
And what is 10% of 200?
20.
How much?
$20.
$20.
So if you look in your journal entry, how much cash do you debit cash for how much? The total of $230, correct?
Yes.
But all of that is not your sales, is it?
No.
How much goes into your sales account?
$200.
$200.
And the rest is owed to the
Government.
as a payable. Absolutely. So when you set up your journal entry, yes, you collected $230 in cash, debit cash for $230, but don't spend the $230 because that's not yours, all of it, correct?
Correct.
Only $200 is yours. Make sure set up a payable for the amount of money that's owed to the government, and you can see what that is. The only amount that goes into your sales account is the $200 that you earned, because you're
Mr.
collecting the rest
Wilkinson,
for the government. Yes.
I have a question. How do we account
Yeah.
for real property taxes?
For the company,
Yeah, would this be a part of current liabilities or we put that on the long-term liability?
usually real property taxes are due every year, correct?
Yes,
So therefore, it would be under.
current.
Absolutely. Very good question. Very good question. So let's say the company estimates real property tax to be, let's say the year end hasn't, because remember, real property tax bill doesn't come out until the next year. So every year the company will probably have to estimate its real property tax bill or even its income tax bill. You follow? So let's say they estimate it to be $5,000. So they'll show real property tax expense, 5,000, real property tax payable, 5,000. Because that's what they estimate they will pay the government as soon as the tax bill comes in. So yes, it's a current liability. Thank you for making that very important point in terms of current versus long term. Somebody's watching The Fresh Prince from Bel-Air? Okie dokie.
Mr. Wilkinson, I ask that questions because, we work in loans collection and most persons have properties and they never pay taxes. So we have to end up paying real property taxes to government on these properties for years and years.
Yeah, that is a big problem in the Bahamas. The government is owed approximately $500 million in real property taxes at the moment because Bahamians and companies are not paying their real property taxes at all. They wouldn't even pay like $10 a month or something. They don't pay. Sometimes they don't pay anything. It's just outstanding year after year. And since government has not been going after people and companies, the bill is now $500 million. We've had a lot of talk about doing something to collect that money. We're still waiting for the government to do something. They say they're working on it. They're soon going to be coming down on people with like a ton of bricks. I just hope that they start with the millionaires first and work their way down to us, the regular folk. You follow?
Exactly.
I have two questions of that, based on what you said just now.
Mm-hmm.
So what is the purpose for the real property tax? Because let's say for a person who would have gotten a mortgage they fall underneath the threshold of whatever the government is saying that you is required to pay the real property tax. What is the purpose for the government to collect real property tax on your home that you would have already paid taxes initially when you would have acquired the mortgage?
Yeah, the reason for real property tax is like any other tax for the government to raise money to pay its bills, whatever it is, to run government ministries, to fix the roads, to pay for education, to pay for national health insurance, or whatever the government pay for civil servants. It's to collect money to pay government bills. That's why we pay real property taxes. And one of the reasons why we pay real property taxes and VAT taxes and all this kind of stuff is at the moment, those are the only means that the government has to get money other than borrowing it. And we know from our earlier discussion that too much borrowing is not good. We're already seriously in debt, $10 billion. Behemoths will be paying that back for generations to come. Okay? So other than borrowing money, which we cannot continue doing indefinitely, we have to raise money, the government, by other means. And real property tax is just one of the means, like that. That's why. The
Wouldn't
problem
that be
is,
a double?
yeah, but that's okay. Some countries have triple, quadruple, can triple, can triple. We are still in the lower bracket. We don't even have sales income tax yet. Most countries in the world have income tax, sales tax, VAT, property tax, and everything all going one time. Our government has just been stenching to not include all the other taxes like income tax yet.
So would the government should be on the and their business, because the government own properties and whatever. Aren't they supposed to pay their property tax as well, or no?
No, the government property owned by the government is called Crown Land, and they will not be required to pay taxes on their own Crown land.
Utter nonsense.
Okay, but remember, the government uses Crown land for government business, just like it uses the taxes for government business. Technically, the Crown land is owned by the people, because the government represents who? Hello, anybody
Supposed to be
know?
the people.
The
No,
people.
not supposed to
Supposed
be.
to.
Not to, I know they behave in such a way it doesn't seem that way anymore.
Supposed to be, that's a good answer.
But the reality is the government is and all the assets of the government are owned by the people. Okay? No matter what people, the government, anybody else try to make you believe. And that's the same problem everywhere in the world. Government issues are owned by the people. We vote for the government to represent us. You follow? So that 350,000 Bahamians are not trying to flick and go to Parliament and pass a law. Do you follow my point? Or manage the government affairs, the people's affairs. That's why we select governments. So they work for the people. And therefore, anything that is owned by the government is owned by the people. Bahamians are just not educated and sufficiently and told sufficiently. We know it on average, but we've been beaten into the ground so much we think we don't own it anymore. Unfortunately. And that's what happens after you get beaten into the ground long enough. If somebody wants to control you, for example, if a spouse wants to control you or somebody in your job, they tell you you're ugly. So now you spend all your life looking in the mirror like, oh, my God, maybe this will let me kill myself. Some stupid stuff like that. Or you're dumb and stupid. And people tell you that long enough, you say, you know what, I'm dumb and stupid, but true, even though it's not true. It's the same principle. So be careful. The people still own it. All right, good point. All right, so yes, these taxes, including real property taxes, for the government to raise money so that it doesn't have to borrow so much money. Because if the government doesn't use taxes to raise money, then you have to borrow it. They're the only two means the government has. Because government does not run business. Okay, private sector runs businesses. So the government needs to raise money in order to pay its bills, pay for education, so that all those government schools have to be paid and maintained, and children can go to school free. That's not free. It's paid from taxes. That's the whole point. When you walk in to get free health care under the National Health Program, that's not free. It's paid by taxes. Nothing is free. It may be free to us, but we still have to pay taxes at the end of the day. So the government can have the money to do these things. Okay? When they dig up the road to put down pipes, it's not free. We have to pay taxes for them to do that because the government has to pay the people who work in the ministry who's digging up the road. Hmm. Thank you for raising that question so I can remind and we can be reminded. Very good point. Okay. All right. We talked about the current portion of long-term debt before when we did classifications. If you're going to pay off your debt within a year, it's current. If it's going to go longer than a year, it's long-term. Okay. Now, the other interesting liability, and remember, these are all just accounting for different liabilities. And as you can see, all of a sudden, yeah, you're raising some very important questions. And in case you didn't really understand the issue of liabilities, it's not only just for notes, there are all kinds of different liabilities that are owed by companies and people. Okay, because some of us owe the bank, that's one liability. Some of us owe the credit union, that's another liability. Some of us owe family members, that's another liability. Some of us owe our spouses that we're never going to pay, but that's another liability. Don't worry, man, I can pay you. It's your wife, you asking me for the money you lend me. What kind of man you is? Even though she said, John, can you lend me that $300? I'll pay you when I get paid. When payday come, wives tend to have amnesia. And so I said, man, I'm my husband, but he is waiting for payment? I'm not paying him a dime. And when I need money again, I can borrow it again. And don't pay again.
So she must be say, can I have them?
Exactly right. Right?
Yeah, stop borrowing.
Yeah, so can I borrow? What kind of nonsense is that? And we all know very well it's not going to be repaid. Especially if your wife, if a husband borrows money from his wife, he may not pay every time, but more husbands pay back than wives. Because guys have this little ego thing. I need to pay my wife this money back. I don't want to hear her tell me, but I like that. Like here is your money or something like that. But wives, wives don't. They don't get embarrassed about it. They're like, I'm not paying that. I just say borrow for the record. It's a joke. I'm your wife. Okay, you snuggle me every night. Now you ask me for money. What kind of man you is?
You're supposed to take care of me.
No. Well, that was the old days. That's not anymore. We now have equality. Women are working, making money. They say they're equal. They need to and all that. They're their own woman and so on. So things have changed now. So guys are not obligated, apparently, under the new rules, to take care of our women anymore. What the new order of things is you share the responsibilities, and that's it. No more take care of anymore. Doggone it. That's another issue. Is that an asset or liability?
Both.
uh, well, see, what happened is my wife is from the old thing. Because, see, my wife she's spoiled anyway. But anyway, when she came to me 20 something years ago and say, can I stop working and then I'll pick up the children and cook for you every day and do all that stuff? I'm like, man, that's spooky. We need both incomes. What kind of, what? But for some reason, I agreed to that nonsense. Not nonsense, whatever. I agreed to that. But that's the old. So now she is completely spoiled. She's like, no, all this stuff. So she does. Lucky for her, I guess. Lucky for her and me. But anyway, uh, that's not gonna be the order of the new day anymore because everybody's now equal, making their own money, making their own this. And now husband and wives, boyfriend and girlfriend have to share. You don't have to pay for your spouse dinner anymore because she has her own money. When you go to dinner, everybody pay their own bill. When the house bills come, everybody pay their share and all that kind of stuff. So things have changed and all that stuff for you youngsters in the new order. Okay, because every time I turn around, I hear make provisions for our women, which is good. They equal pay for equal work. That's good. The only other problem with that is that because of that, now the whole take care thing is going to change. Because now, if you are equal pay, maybe sometimes more pay, then because of the jobs that we have, then I can't do that anymore. You have to pay like share. So things are changing for better or for worse, but that's where we are. All right. So the current portion of the long-term debt, my baby who just graduated, he's like, Daddy, I'm not getting married right away, but I need to ask you when I get married, like you took care of all this stuff with mommy. I said, hell no, you can't do that. Don't do that. You're going to drown. What are you going to do it with? Dude, if your wife works, she has to help you pay the bills. If she makes more, she has to pay more of the bills. He said, but Dad, I said, you asked my opinion, didn't you? That's the new order. This thing you saw with your mom growing up, that's the old school. That doesn't exist anymore. Don't mind your dad doing nonsense, so to speak. Okay, I know chicks don't want to hear that. But anyway, yeah, things are changing. All right. We also have this other set of liabilities that we call payroll liabilities. Basically, we all, I think, know what that is. Companies have payrolls, but on those payrolls, we have all kinds of deductions going on. For example, in the United States, my son lives in New York, and man, by the time they finish deducting, I can see why people are still, man, they need more money because there are all kinds of deductions. And depending on what state you're in, the rates are higher than other states. For example, in the US, very common withholding taxes and all that stuff include what? Federal income tax comes out of your salary before you get it. State and local income tax come out of your salary before you get it. Social Security, which is national insurance equivalent, come out of your salary before you get it. Medicare comes out of it before you get it. All those things come out of your salary before you get it. How about that? In Nassau, we only have one little itsy bitsy thinking NIB deduction at the moment. But we're thinking about a Medicare healthcare deduction soon to help us pay for national health insurance, which is a good thing. I just hope they take more from people who make more, rather than taking the same thing, like from poor people and rich people pay the same thing. Anyway.
So if this is with these additional taxes, wouldn't they have to increase the minimum wage? Or
They
no,
don't have
it'll
any,
only be a percentage.
no, they don't have to increase it. They might, but they don't have to.
So it will only be a percentage based on, oh, I'm jumping the gun in this aspect.
It'll be a percentage based on current estimates. Does that mean
Okay.
minimum wage will go up? Not necessarily. It should, but not necessarily. Because the minute you say increase minimum wage, and people who pay minimum wage, like housekeepers and cashiers at the store and stuff, the owners who make millions and millions, they start complaining, you want to increase minimum wage, you're going to stop hiring as many people and threaten you not to do it. So it's all stinky stuff going on. So we have to think about it very carefully before we do it. Okay? But we might. Yeah, absolutely. The thing is, we don't have too many deductions in the Bahamas yet. Like in the US and Canada, there are all kinds of deductions. But I guess we'll get there eventually because government needs money more and more, as you can see. We can't keep borrowing, so we have to make deductions. Okay. All right, hopefully income will go up a little bit as well to accommodate some of the increased deductions that we will see in the future in the Bahamas. So far, though, we've been fortunate. Our government has been either managing and mismanaging money pretty well. Some manage it well, some don't. But we've been borrowing a lot, so we've been able to keep taxes down. So people have not been paying a whole lot of taxes, even though we say, I don't want to pay no real property tax, I don't want to pay VAT, I don't want to pay nothing. Go borrow the money. Then when you borrow it, then the country say you over borrowed, and then you can't borrow anymore, and then you don't have any other source of income. And people say, what happened? Why you didn't find money? And then we say, we tried to find it. We tried to tax you, people, you complain. So it's a very interesting process. But there has to be some form of taxes for the government to function because the government cannot keep borrowing. We all know the problem with borrowing. Think about it in your own personal life. If you keep borrowing all the time, soon you don't have any money to pay for anything except loans, correct? Correct?
Correct.
Countries are that way. You keep borrowing, whatever money come in, you don't have any money left after you pay. The loan to the IMF and the other Fs and the FCS and the Development Bank, the other bank and the other bank, just like in the personal life. So we can't keep borrowing because soon every money we collect in taxes, you have to pay on the debt. And then we don't have any money left to fix the road, go over the hill to fix the plumbing, or pay for education and pay for the doggone $40 million a month that has to come in for the BEC, keep the lights on, all that. A lot of Bahamians still don't know what's really going on.
And the interest gets higher.
Of course. which means that you have to pay more. So whenever the money the government collects to pay more on principal and interest. Sometimes most of the money goes to interest anyway, and the principal doesn't move.
Nope.
A lot of behemoths don't know what's going on. They just say, look, man, look here. I wait for you to hotel. I don't want to hear about what your problems are. Just give me my money. Let me go gamble and do what I doing. Buy my uniform for my children now. I'm showing you 7 why. And they don't get the why either yet. Like every other country, we have our share. It's not as kosher as you might think. Some of us are doing well, and so we don't think about the details. Some of us are not doing well, but we have enough to have fun on Friday, buy some shoe for their children when whoever show up when they feel like whatever, and so on. So we just keep going on like everything is whatever, but it's not necessarily so. When you get to understanding the details of what's going on a countrywide basis, it gets a little spooky actually. All right. So the example that you would see in your text for payroll is a very simple example. They give you a lot of stuff to read. Read that for information. It's US based, but we have our version of it. It's just that we don't have all these deductions yet. But it's the principle is the same. We will be having some of these going forward. It's just a matter of time. Okay? So in your text, your example for wages expense, what was the total wages in your example?
65,000.
Okay, same as mine. Notice the total payroll for all the employees for the month of February in this example is $65,000. Now, notice which account we debit. What account did we debit for the payroll?
The payable account and the wages payable account. No? The wages expense was separate.
Yeah, we debit wages expense, thank you, for 65,000, which is the total payroll. But that's not the amount that the company actually pays to employees. Do you see that?
Yes.
How much is wages payable to the employee?
42,000.
Where did the rest go? Where did the rest go?
Taxes, medical insurance, pension.
Some payroll related entries.
Yeah, we have a fancy name for it. It's called deductibles. Any of you have any deductions on your payroll?
Your national insurance.
Mm-hmm.
Yeah, and if you work for government, you have loan payments, then you have loan payments coming off, right?
Mm-hmm.
And if you pay part of the medical bill for depending on which company you work for, that will be coming off too. Yeah, they call deductions. And that's what all these other amounts of deductions. Okay? And these deductions are shown as payable because the company has to take it out of their salary and it's payable to the government because every month the government has to get these deductions because they're being deducted for government. Just like national health insurance and the NIB. Okay? So yeah, the payroll total expense is 65, but the amount paid to employees only 42 plus. The rest are deductions that are paid to the government. And then on top of that, the company itself has to pay some other deductions to the government by law. And in this example, the payroll taxes and benefits expense that the employer has to pay works out to be how much? How much does the employer has to pay in taxes? I see 18. Do you see 18?
Yeah, 18,000.
Yes. And as you can see, that 18,802 goes to various categories to the government as well. So you have the payroll deduction for the employee and the payroll deductions for the employer, just like with their national insurance. Remember, national insurance in the Bahamas is broken down into 2 deductions, an amount paid by employees and the amount paid by the same thing here. The only reason why it looks like a big old monster because we only have one deduction so far for government, and that's NIB. Isn't that great? I mean, of course, we have real property tax and all that, but that's billed at the end of the year separately for anybody who's bold enough to buy a home. Because buying a home is no longer buying a home. It's involved a lot of things. Real property tax kicks in. Annual insurance, big time insurance premium, and they're killing people. They're killing Bahamians, especially working Bahamians. Correct? I don't know why the government doesn't force insurance company to charge premiums according to income. So if you make 50,000 or less, doggone it, give a reasonable rate. If you make 51,000 to 100,000, you pay a little more. You make more than 100,000, you pay a little more. And doggone it, if your income is $1 million or more, you pay more. So that poor people doesn't have to what?
Suffer.
For everybody who can afford to pay, flicking more. Sorry. Flicking? I am not apologizing. I only said sorry for the record. Because it has been going on forever and ever. And nobody seems interested in doing anything about it. You know, those people that we elect every day say, vote for me and I'll set you free. I promise, if you vote for me, I'll do this. And I promise, if you vote for me, I'll do that. And I promise so eloquently that I'll promise to promise whatever the hell I could promise. But at the end of the day, poor people are still bearing the burden of these taxes.
But Mr. Wilkinson, wouldn't it benefit? It would also benefit the person if a certain percentage comes out, because at the end of the day, for example, with NIB, you could be making 100,000 a year. I'm making 50,000 a year, and both of us paying that ceiling, and at the end of the day, we both get the same amount as a NIB pension. Like, that don't make any sense.
That's what I'm saying. From one decade to the next, from one party to the next, the same crap remains.
Yeah.
I'm sick of discussing this, the actual issue. We all know you're right. That's the problem. Okay, same thing for healthcare. The insurance premiums are ridiculous. Plus, they're charging back on insurance premium for medical and all that crap. How are poor people supposed to survive? That's why we still having cookout and dropping dead.
Well, they just don't care. That's what it boils down to.
Implement a national Medicare program where you make deductions according to income. So those people who are rich pay 3 times more. After all, poor people are making you rich. True or false?
True.
True.
Anyway, who the hell goes to the movie theater to make movie stars rich? Poor people, correct?
True. Yeah.
Man, we need to get it together. Anyway, I can't afford to get a house that gets sick because
that is only to continue to keep the poor people poor and the rich out to stay rich.
I know, we all know it, but nothing ever changes. The poor people who have the voting power don't say, we're flicking tired of you people doing it. The next time you try to never vote for you again. Do it or else we'll never, and then do it. But again, our politics is another issue. See, that's the next thing. All right, you young people, I'm just dropping little things. Maybe you might have the guts before you, like my Grammy used to say, before you're not dead to do something. Because the last 100 years, nothing. Okay. How do I get on that? Payables, kiss my foot. All right. So these are all the different kinds of payables that we need to know as accounting people, and certainly now you can see even as regular individuals. All right. Unearned revenues create payables as well. I think we may have talked about unearned revenues before. What is an unearned revenue by definition? Anyone?
Advance payments for goods or services that a company must provide in a future period.
Okay. Pretty straightforward. So what do we mean by advance payment?
I pay you in advance. If you were supposed to get paid like next week, I give you money this week.
Right. So you ladies, when the contractor come and say I need $500 to get started on that work, I need you to pay me up front. That's what you're doing. You're paying him in advance, aren't you?
Pretty much.
You are. Because if you give it to him today and he's coming next week, you paid him in advance. In the account, in his books, he's receiving the cash as a debit. That's why we debit cash. And in his books, he credits unearned revenue because he hasn't done the work for you yet, has he?
Nope.
So whenever you get money in advance, that's the entry you need to make. That's all I'm saying. Debit cash for the money you got, credit unearned revenue because you haven't earned it yet. When will you earn it?
When the job is done.
Okie dokie, which is not a problem. When the job is done. But accounting don't worry about that problem. Accounting worries about the proper accounting. Okay? So whenever you get money in advance, you debit cash, credit unearned revenue. Now, in your example, we have a little situation where $30 is credited to revenue and $30 is debited to unearned revenue. Does anybody figure out why? Why is $30 being debited to unearned revenue and $30 to revenue? Think of that for a moment. I'll be right back for an answer.
Can somebody tell me what page we're on?
419.
419.
419. Rose question? What?
Why was the $30 debit to unearned revenue and the revenue expense credited? He was asking about the $30.
Okay. Recorded revenue earned.
Well, I guess the revenue would have been earned by now. Before it was unearned, now it's earned. The job would have been done.
Okay, first of all, does that $30 have anything to do with the $360?
Ooh, let's see. Who's that?
Yeah. Yes.
It does. So what does the $30 represent?
1 month earned revenues.
Yes, 1 month of earned revenue. So when you get money in advance, if it's going to take you 6 months to do the job, you have to account for what you've earned each time you provide some work on the job. So you did $30 worth of work in this example. So out of this $360 cash you got, you only earned $30 of it. And so accountants have an entry for that. When you earn the $30, we debit unearned revenue to reduce the unearned amount, and we credit revenue for the $30 that you earned. Once you do that, how much remains unearned?
$330.
Okie dokie. Man, wherever you guys end up, you're going to be happy you've really gotten a good grasp of this thing. Despite all the blah, blah, blah. Okay? And so now you see this is how accounting works to keep everything organized. You can also see that if you don't have these things in place, how disorganized and discombobulated things can become. Somebody called me a couple of weeks ago. Somebody said that I do client consultancy in accounting and finance, and I said, yes, I do. What's the problem this time? They said, oh, we started this big time, blah, blah, blah. Not big time, but medium-sized business. And now things, 2 years ago, and now things are beginning to pick up this year and get off the ground. We need somebody to consult and give us advice. I said, okay, but it's not going to be free though. Oh, no, it's not going to be free. So the first thing I said to them was, can I see your financial statements for the last 2 years? What do you think they told me?
Yeah,
What financial statement?
Yeah, they say, they say, they say, "Nothing."
that was a foreign word to them.
Yes, we ain't got none. I'm like, you have this big time license to do this thing, you ain't got none. Suppose somebody wants to invest, or they so you don't know what you did for the last. All you did was money in the bank, money out of the bank. You don't know what the hell happened. Like, no. I'm like, you don't even have like a draft or something. Like, no. I'm like, you know what? Before we go any further with whatever you want to consult on, you need to update your financials. First of all, you need to have financials done for the last 2 years so you could see where the hell you're going this year. And so anybody who wants to know, they could see what happened the last 2 years, for better or for worse. Oh, I said, okay, give me all your files in an organized fashion so I can start preparing the financial statement. What do you think they did?
They drop you.
They said, we have everything ready. When I went, they one old rickety box. They grab
Like
stuff
this.
and they throw some stuff in, like, that's it. I'm like, these are your files for the last 2 years that you need for that. I said, yes. And they're in no particular order either. They all come bubble up. From Tom Jones to Perry Mason to thinking the Jetsons. Everything is thrown in there in one bubble thing. And this is not mom and pop shop. This is a major thing. They have a lease for some place in a very sophisticated area where the lease payments are high. And I'm thinking, this is a common problem. Everybody's looking at the outside and not looking at the inside. Just a little heads up. So yes, that's how we account for that. Yes.
Hi, I just want to backtrack something, please. On
Mhm,
page 418, right? This
mhm.
was a journal entry right before we look at the 360. And I am reading through the question, recording employer payroll taxes and health insurance costs and pension benefits.
Right.
And I'm trying to understand what the transaction is when they would have asked 50% for the payroll taxes. I'm trying to get an understanding of how they came about to these figures. I am not following that.
Oh, did they give you any data before the journal entries?
Well, the data that they would have given us would have been the 65,000, and then they gave us those federal income taxes and stuff like that.
Right.
But then in addition, they had some other transactions on payroll taxes, 50%, health insurance premiums at 80%, and the pension contributions at 50%. So
Now, are you wondering where they came from? You
I
want to
didn't
know
hear
where,
you.
you want to know where they came from?
Yeah, because I was trying to do the calculation so I can have an understanding and follow what they were, where the figures would have derived from. And I still using the calculator, I still can't follow.
Yes, yes. Now you're looking at the journal entry for the employer with the 18,802?
Yes.
Uh-huh. Okay. So the employer's side of it in total was 18,802. And then you went to the credit side to see like where those individual amounts came from that added up to 18,802.
Yes, because I would have thought the first journal, which was 65, which is a wages payable of the 42,428, that should have had something to do with this particular journal. So where does this 18,802 come from?
Uh-huh. Well, if you look at the journal entry for 18,802, what is the debit? What do we debit? That's the employer side. What do we debit?
We debit the payroll taxes and benefit expense.
Right, that the government says the employer has to pay. You follow that?
Mm-hmm.
Okay. Now your question is, where did that come from? Well, if you look on the credit side of that journal entry, you see a list of individual payable amounts, right?
Yes, I do.
And if you add them up, they will equal 18,802.
Yeah, but the question is that like how the transaction on February 15th, Teresa records the fitness center share payroll taxes 50%, health insurance premiums at 80%, and the pension contributions at 50%. So based on this information here, what is being used to calculate this journal entry?
Okay, let's go back to the first one. You said the first bit of information was 50% of something?
Yes, they're saying that Teresa records the fitness center share of payroll taxes 50%. Now they
And,
didn't give us an amount.
okay, so they said 50%, but they didn't say 50% of what?
No.
Okay, and then the other percentage was what?
The health insurance premiums 80%,
Right,
and the pension contribution 50%.
right. Now, uh, in here's what happens. They didn't show you what the 50 and 80 and all that was a percentage of. And the reason why we didn't do that is because the percentages would be supplied by the government, and the government would indicate, for example, if there's a medical plan, for example, whatever the total medical cost is for deduction, the employer may be required to pay 80% in this case, and the employee would be required to pay 20%. So it'll vary depending on the organization and the governmental requirement. Those percentages are to give you an indication of what the government may require you to pay in terms of the employer's contributions. So yeah, you won't see how we necessarily arrived what's 50% of, 80% of, but in practice, you will be given all the information you need to apply those rates. For example, just like an NIB, we know that the employee pays what percent of the NIB? Anybody remembers? Was it 5%, 6%? What does the employee pay? You guys are like me, we don't even think about that stuff. In any event, for NIB, the employee pays a percentage, 5% or something, and the employee pays percentage 5.9, whatever it is. And then that total amount is sent to NIB on behalf of the employee. So those percentages that you see are just to give you an indication of what the required amounts might be. It will not necessarily work out to the numbers in the journal entry. The journal entry is really just to show you what accounts are debited, what accounts are credited, the actual numbers. For example, if I wanted you to, in your journal entry, to show the employer's part of the medical commitment, I'll say to you in the question, the total medical deduction is $500, of which the employer will pay 50%. Then you can go ahead and take 50% of the 500 because you have all the information. And that's really the only reason why those percentages are there, to show you that in the real world setting, you will be paying a percentage of a given amount. That amount can vary depending on the employer, the amounts, and so on. So it will not necessarily come back to those numbers you see.
Okay. Thank you.
Yeah, the only thing you want to be aware of is in those numbers is what accounts are debited and what accounts are credited for the employee, and what accounts are debited and credited for the employer. And all the data will be given to you as required. So if you're just given the information, you just do the journal entry. If the examiner or the government or whatever wants you to actually do the calculations, they'll tell you 80% of this amount needs to go, 50% of this amount needs to go, and then you go ahead and do that in practice. Okay, so that's a great question. Right? I'm happy to see though that you're actually trying to check it back, which is really cool. I encourage students to do that. All right. And then we have some other payables among all those other payables. So you can see this payable thing is not an overnight affair. It's a big deal. All right, income tax is payable. The government will tell you like VAT. VAT is how much?
12%.
Right. We don't have income tax, but we have VAT. And so every time every company in the Bahamas, whatever VAT payments that they collect, they have to pay to the government. Some companies spend the government money, and then when it's time to pay the VAT, they don't want to pay the VAT. And then the government gets upset and say, pay the VAT or else. Okay. All right. So income tax is payable. It's like that. If you owe the government, you have to set it aside. So when it's time to pay, you can pay. Property taxes, remember that one? You know property tax bills coming every year. Don't act like it's not coming. But Bahamians have acted to the tune of what? $500 million. That didn't happen overnight. Those are taxes due to the governments from since Sir Roland was premier. Anybody know Sir Roland?
Sir Roland Seminar?
Is there any other Sir Roland?
I just want to make sure I heard you correctly.
Yeah, I know it's weird to say that. Yeah, but some of those taxes are from as old as from his time. In other words, they've been around a long time. If you guys could have access to the tax records, you'll be shocked how far back those taxes have been accruing. Remember that word?
Mhm.
Like my grandma used to say, you can't say I ain't tell you no. You know, you young people, do something. I don't know what you're gonna do. It's been around a long time. Can we do a lot with like 50% of that $500 million?
Yeah.
Yeah. How much is 50% of $500 million? Anyone know?
500 million.
No, 50% of $500 million. Not 1 billion. 50% of $500 million.
Oh, $500 million.
Mm. How much is that?
That's 250 million.
Couldn't we do like a few interesting things with that?
Yeah.
Yeah. So we get if we 50% of the $500 million from the rich people first, wouldn't we like have a lot of money to do some stuff with already?
Yep.
So why wouldn't we go and get it from the rich people first? I know. It's an interesting question to answer.
And
The
that's a
rich people
great,
who,
Mr.
the
Wilkinson.
rich people who have
All
the
right.
majority of that money owing.
Of course, and the ability to pay.
Yeah, only us poor people only have a drop in the bucket.
And the inability to pay.
Oh, I guess they don't buy the hands that they beg from.
Food for thought. Yeah. So yeah, accounting is not just debits and credits. Accounting gets you to thinking about other things, doesn't it? Tied up in all kinds of stuff, by the way. All right. So you youngsters who are the future, just some food for thought as you go forward. All right. Now, product warranties, they're a form of liability. For example, when a company gives you a warranty, they don't know how many people will come back with defects, so they make an allocation just in case somebody comes back. Accountants need to account for warranties, whether anybody comes back or not. And so in this example that you're given in your text, do you guys have the example, product warranties?
Yes.
Yes. The company estimates that their warranty liability is going to be about $2,100, right?
Correct.
Okay. Now, how did they get the $2,100 estimate? Remember, when you give a warranty, you don't know how many people are going to come back. Maybe everybody, maybe nobody, maybe some. So you estimate what your expense is going to be and what your liability is going to be. How did this company estimate the $2,100? It's right there in the journal.
6% of the mufflers sold has been returned for replacement under the warranty. So they did the average cost of the
Yeah.
muffler.
Yeah, the number of units sold. Well, first of all, we start with the number of units sold, which is 700. And then we apply a replacement rate. Of how much? 6%, yes. Because we estimate that based on historical records in the past, that's the average return rate on the product warranty is 6%. So we apply the 6% to the 700 that was sold under warranty. So that estimated units to be replaced under warranty is estimated to be how many? Estimated units to be replaced under warranty is how much?
42.
Yeah, 42 units times the cost of each unit, which is?
$50.
$50. Okay.
So based on the amount of units we expect to be replaced because of defects or whatever, 42 times $50, the company is estimating that the warranty liability will be $2,100. As simple as that. There's no magic. There's a method to everything. You just have to learn it. Remember, I tell you, you're not supposed to be kissing with your eyes open. Anybody kissed anyone with their eyes open lately? No. We all learned somewhere along the way that when you kiss somebody, you kiss your eyes. Same thing. If you want to determine product warranty, don't try and stress about it. Go back and see how it is done. And in this case, it's estimated to be $2,100. So once we find out what the estimate is, then we do a journal entry, which is, what do we debit?
Product warranty expense,
Yes. And what do we credit?
estimated product warranty.
Liability.
Liability. Why do we credit a liability account for the 2,100? Think about it if it was your own business. Why would you credit a product warranty to liability? Now, folks, remember, when you go to buy a TV from Walmart, what don't you say, is there a warranty for this?
Yes.
Yeah.
Why? Why do you ask that question?
In the event something happens, you could return it at a later date.
And get another one free, right?
Yes.
Because that one they give you was defective or broken or whatever. So for us, that's a good thing. If something happens in the warranty period, we return it and get another one. But them, when you return it and it's broken or defective, they have to get rid of it, right?
Yes.
So what they have to do is they have to set up a liability, because anytime they give you a warranty, that's a liability for them, because every time you bring a broken one, they have to give you a new one. So that's a liability for them. Does that make sense?
Yeah.
Okay. And that's why we credit a liability account. All right. But that's the accountant's job. The person who bring it back, they don't want to hear about no debits and credits, right? There's look here, break. Am I on a new one? That's all they're interested in. Give me it now. I gotta go. But the accountant and the company has to be concerned with it after the customer leaves, and make sure that it's properly accounted for, and that's how we do it. Okay. So a little further down, somebody brings a defective item under the warranty, and now we have another entry we need to make every time somebody returns an item. In this example, how much cash did we receive when the item was returned?
$30.
$30. But in our example, it doesn't end with the cash we receive. We also have to debit the liability account because an item was brought back, so we have to reduce the warranty account, the liability account, by
$60.
$60.
$60. Why is it $60?
The cost is $60.
Yes, the cost of the muffler that was returned is $60. And so that has to be accounted for when reducing the liability, warranty liability account. Okay? Now, watch this. Where did the $30 come from?
That's a restocking fee or service fee to have it replaced.
Aha. So, am I the only one getting the picture, or is everybody else getting this picture now for a warranty return? You, the customer, bring it back, say, change this muffler and go, speed off. The company doesn't stop there for them. Okay? The company has a stocking fee for bringing it back, $30 that the customer has to pay. And then the liability account has to be reduced because a muffler has been returned. So the warranty under that is covered. No longer is it a liability for that muffler that's been returned. All right? So we debit cash for the $30 service fee. We debit the liability account for the item that's returned, because now we've replaced it. We credit sales revenue for only $30 because that's the only revenue we earned. What else do we credit?
Merchandise inventory,
Why?
plus they're replacing it.
Are we going to put that one that was brought back broken in stock?
Nope, I guess you're gonna
No.
discard that.
Exactly. And so when you throw it away, you have to reduce your inventory by that one, right?
Right.
Yeah.
Okay. Now, even if you don't reduce your inventory for that one, you have to give them a new one out of inventory. So you still have to reduce inventory. You follow?
Mm-hmm.
So that credit inventory is really for the new one that you put on to replace the old one that's broken. All right. So there you go. It's not that complicated. It's a lot of narrative sometimes that you have to read, but at the end of the day, that is to get you to understand what is happening. And once you do, it becomes very simple. Okay. Vacation pay, a lot of liabilities on it, huh? You spend the whole day on liabilities. That's how serious liabilities are. And sometimes they make us because we need them, and then if we don't honor them and respect them, they will break us, individuals or company alike. All right, vacation pay liability. Sometimes companies want to estimate what they have to pay out for vacation pay for a month, or a quarter, or a year. And so when this estimate is done, in your example, the estimate for vacation liability is $1,200. So what do? We debit the vacation expense account for that, and we credit a liability for vacation pay. And why do companies do that? As a planning mechanism, so that they can be aware of what the commitments are going to be for upcoming vacations for you guys. You don't see that part of it because all you want is your vacation what?
Okay. The thing is that I know in our company, we have to put in our vacation by November of the previous year.
Yes.
So therefore, the company can have an idea of who's going on.
And what,
It isn't like they pay you actually prior to you going on your vacation because it still is on the same pay cycle. So I don't understand why is a need for that.
the need for that is because the company wants that information to know who is going to be out of the company and when for the next year, so that they can plan estimate, just what I'm saying here, their liability for vacation the following year, oftentimes for budget purposes. You follow?
Okay.
Yes. That's a good point that you made. All right. And a lot of people don't really know, and they wonder like, why the hell are they requesting it now? Why can't they wait until next year? Because coming towards the end of the year, companies are starting to budget for the next year. And if they have an idea, not that it'll be exactly, because things change, but it'll give them an idea of how to plan for who's going to be away and how much it will cost vacation expenses the following year. So they can make sure they have the what? Money available and people available to come in and work for you or to transfer across to fill in while you're gone, things like that. Okay. Good question.
So, I have a question. How does
Yeah.
a company account for when you go on vacation? You can apply for advance pay. I think our company does that.
Meaning you get your
Okay, if I
vacation
go on a
before the
vacation, say next week, I mean,
Right.
okay, I get paid next week, but I have started vacation the following week, and I'll be off for 2 weeks. I can ask for my pay, advance pay, while I'm
Oh, you
on
mean
vacation.
yeah, rather than just get it the normal pay period.
Yes.
Yeah. Uh, for most and every company has its own policy on that. Okay. Some companies will just write you a check for the advance pay and then accrue it for the week. If you get paid weekly, they accrue it each week for the 2 weeks. You follow?
Yes.
In other words, they'll debit salary expense and pay you now, and then they'll set up a payable account and accrue it. So the end of the first week when you're gone, they debit. You see what I mean? And they'll expense it for the end of the first week and reduce the liability. And then the next week, and then it's done. So that's typical for a lot of companies in terms of giving you your salary, your vacation upfront. Okay, absolutely. They don't change the flow of things. They just write you a check and accrue it until the accrual period has passed, and then we go back to normal as far as you're concerned. So you're back to work, and we're back to the usual stuff. Okay, that's a good point. All right. There you go, a whole bunch of liabilities that you probably never even thought about in your life. And if you did, you're probably thinking about them a little differently now. And companies should be thinking about these things all the time because liabilities are a huge part of the success or failure of a company. They cannot function as a company without liabilities, but they will certainly drown if their liabilities are not controlled. All right. And then just before the end of it, I think we have this thing about contingent liabilities. Anybody ever heard about a contingent liability?
Potential liability.
Yeah, potential. Contingent means something has to happen for the liability to arise. And in accounting, the important thing to know in accounting, if it is not likely that, if you're not sure if it's going to come to fruition or not, don't put it in the accounting records as a liability, but put a note in the financial statements that there is a contingent liability. If we win the case, we wouldn't have to pay anything, the $5 million. If we lose the case, we'd have to pay the $5 million. It can go either way. Since we're not sure, it's contingent, so we won't put it as a liability in our balance sheet, but we will make a note to the financial statement so that the shareholders and others will know that this thing is possible. A lot of companies have contingencies like that. They don't disclose them because they think they're going to spook shareholders. And so they make an error of omission. But it's not an error, it's deliberate. They leave it out intentionally, which they should not do. But as usual, when senior management is crooked anywhere, dog eat everybody's lunch, like the head of the snake. The old people say you want to get the snake cut off the head. You want to fix the problem, fix the head. Don't mess with bring them down the line with Susie. Now, Susie and John them are not the problem. They might run off with a couple bucks and egg here and there, but they're not the real problem. The real problem for most organizations are board members, CEO, CFO, this O, the other O, the other O, the FQT, whatever that is. All right. The worst damage ever, always, is done at the top. Top of the company, top of the church, top of the home, top of every bloody thing. Top of the parliament, even. And we keep trying to figure out, no, yes.
It's provision for losses. That's not contingent liability, right?
No. Provision for losses is an estimate, but it's not contingent. Good question. Doggone it, you guys on a roll. It's an estimate that must be done and shown in the balance sheet every time. as opposed to a contingency. It may or may not be shown in the balance sheet, but either way, it must be disclosed in the notes. Good point. Okay. So the provision is a must. The contingency is a may. My. Oh, nice. Okay. Anything else of interest? Okay, the time value of money is, I think, is the last thing on our list. But you know what? Here's what I'm going to do. I'm not going to get you guys into present values today because we're going to get tied up in it, and I've already held you too long. You've been fantastic. When we come next week, we will finish up this little discussion on present value. If I don't start there, somebody says, excuse me, present value, and then we'll go into, I think, what is it, chapter 10, long-term assets? Is that chapter 10?
Yes.
Yeah, then we'll go into long-term assets. So if you haven't read it yet, please go ahead and do that. We'll do time value of money for the first few moments, and then we'll get into the long-term assets. Of course, you know, my final thing is
Homework.
absolutely. All right, here we go. Page 361. P3.
We did that already.
We did?
361.
P3, requirement 1 and 2.
You say 361?
Yes. Yeah. Requirement 1 and 2. We did that last week.
We did? I thought I omitted that last week. I didn't?
No.
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 You said P3 on 361?
Yeah.
We didn't do
We
three.
didn't do that.
We didn't do that. We do 1 and 2. We didn't do 3.
We did P2.
Yes, we didn't do 3.
Oh, P3.
Yeah, I know it looks like it, but we didn't really do
Okay,
that one.
P3. Okay.
Okay.
Okay,
But I like that though. You guys will make some good parliamentarians in future. I'm not kidding. You need people that, yeah, sometimes doesn't matter whether you right or wrong. You just say, I flicking object. And they say, to what? I don't know. It just doesn't feel right. Yeah, shake
Just be
things up.
wrong
How's
and
that?
strong.
Yeah, why not? Because sometimes I get people like, oh, and then people start thinking, even though you may be wrong and strong, and then beg to be corrected. Just make sure you make some noise. How's that? Okay. Page 361. I just made it dramatic so you guys could, you know, when you get pissed off enough to make some noise. Page 361, P3, requirement 1 and 2. Page 362, P4, requirements 1 through 5. And finally, page 444, P2, Part A, requirement 1, and Part B. All right, have fun with that crazy.
Can you run through that again for me, please? I want to be certain I have everything.
Page 361, P3, requirement 1 and 2. Page 362, P4, requirement 1 through 5. Page 444, P2, Part A, requirement 1, and Part B. All right, so good luck with that. As usual, if you get stuck anywhere, please drop me a note or something of that nature. Cheryl, are you there?
Yes, I'm here.
when you get a moment after the class, just send me an email so I don't forget. Refer me to that thing so I can look at that for you, and then I'll get back to you to see if we can get rid of that knot.
Okay, thank you.
Absolutely. If there are no other questions, they tell me there's a third wave out there. You guys be careful. If you have any significant others, tell them be careful because whatever they get, you get. If you have any children who are hanging out with teenagers, tell them stop because whatever they get, you get, and so on. All right. So be careful out there so you can be well enough, all of us, to come back here again next Saturday at 9. All
Mr.
right.
Wilkinson.
Yes.
All right. You said page 444, part A, requirement 1,
Yes.
and then part B.
Yes.
Yeah, indeed.
Okay.
Mm-hmm. Way to go. I like that. Here's what I like. You like, see, and sometimes I know this sound a little redundant, but it's very important. So I said, here's the homework. Some people got all of it. Some people said, excuse me, can you repeat that again? I want to make sure. So I said, okay, here it is again. And notice I didn't say like, what's wrong with you now? No, because you're not supposed to. You go through until you get it. And then at the end, somebody came back and said, wait 1 minute. Let's try that third one again. And that's what I want you to do. Don't say, well, oh, if I say that, somebody's going to say this. To hell with it. If you need it, raise it. Do I sound a little dramatic this morning?
No.
Oh.
It's okay. I think we're used to it by now.
Yeah, actually, I'm just trying to leave a little footprint for you guys so when things get rough and somebody pissed you off and you need to deal with why the hell that nobody's collecting $500 million inflicting tax, stuff like that. I'm just trying to leave a few footprints because soon I'll be off on cloud something, having whatever they have in heaven. I know it's probably not a martini, but whatever it is, watching you guys to see what the hell you're doing. Okie dokie. Have a great week. I'll see you guys next week. Please be safe. I'm here to answer any questions if any come up along the way. Okay?
Okay, thank you.
Fantastic. You guys take care.
Okay. Mr. Wilkinson,
Yes.
just to let you know, I was present, Dion Stubbs.
So I
was
know,
like,
Dion. I know some of the voices. I don't even see. Let's see. Somebody did say I did get the note, and somebody said, "Okay, I have you, Dion."
okay, thank you.
Absolutely, you're quite welcome. You guys take care. I'll see you next week.
Yes. Mm-hmm.
Take care.
Yeah.
Bye bye.
It coming up? Get some ice then. Get. Yeah.
Wow, I want to be right there.
The place in Harbor Bay, okay, next to Windermere. I forget, it called Smart something.
Okay.
It was only $19.99.
Oh, I didn't get one of them.
And you charge it up.
Oh.
And I charged up for weeks.
Mm-hmm. And then you just put it on there.
Yeah, you don't screw it on, just rest it on the top.
Okay, I need to get one of them firewalls. But did you come in?
Yeah, I have that one and they keep breaking. So I saw them advertising this and it does work.
Okay.
Yeah, 1999. And it's worth it. Like I say, I charged that like a couple weeks ago. It comes with a charger.
Okay, very bad.
Just one, that's why the water ain't coming up.
Oh, okay.
It wasn't too bad. I leave out, I bought a birdie, I started to leave out and go up 6, but I left out there like 8, but Chelsea is, I don't know what happened to them today.
Or they
It
were
was
leaving.
moving so slow, and then when you get in that line, you can't get, like, you can't get out. Like, one man, he was in the next lane, he said, "Miss, I done late for work." He said, "What they doing?" I said, "The thing about it is you can't move, because they ain't get no exit to
Oh,
come
one
off."
way in, one out.
Yeah. They need to have like a service line if you gotta come off the line. I was like, oh my, and that's my second attempt there, because I tell Lubin yesterday, I say, "Man, Lubin, we so burnt," because I say all week I wanted to come in early so we could do that thing. But I tell him I get up, but I just didn't get myself together. You're tired. And that's what I was telling them yesterday. You know,
And then
I
we
say,
discussing the same.
yeah, you know, so he said, "Oh, he just," I said, "Well, John, you single, you all got no use to
Yeah,
live for."
yeah.
And
You have
whatever,
a
so,
home and family.
yeah,
And then when
so,
you come in, you got called today.
exactly, so I tell him, I say, "You all got nothing to do, all you was doing is what?
You see what time you see this, turn up before you go home? You see
Yeah,
that?
because he know he's be that late.
Yeah, when you go home, all you gotta do is probably go home, shower and go in his bed. Ain't have no
And
children to
sometimes
do
he's
that, no
go there
wife.
on Saturday, it's just like last Saturday, I went, what I went to do?
And he was
Fool
there?
around with them insurance. You see?
And he was there too?
No, but he said, he asked me what time I came, but I told him I went late because I had a hair appointment, and when I left from there, I went, and that might have been like around 3 or so. But he said he was already gone, because I know nobody was there. I know Carmel said she might have come in, but sometimes she's going on Saturday mornings too. But it's too much, and that's what I was telling Jan. She's saying, you know, the more we do, the more they pile. But I said, that's true what Sharon saying. She's saying, Dion, you all have to work within the required times, because, and that's why I said in the meeting, not to say you saying we working late. Like it ain't like we on the job and we slacking. So that's why we ended up there late. But the point is we working late. So that's why I said to Antonio, is management taking that in consideration? Because they might see that, oh, they getting plenty done, but they ain't looking at the hours would be putting in. Yet they still coming back with flipping, but your mental state, and if you're walking and you hear what she say, she's go walking and this, that, and that. They could do all that because all they doing is delegating. And if
And
they,
she must get up 10 o'clock.
yeah, but not only that, Michelle, if you take a count, like for instance, I wrote down, well, not wrote down, I have everything with all them reports. How the hell, and everything is a priority.
Oh,
to
yeah, we
them.
have something to
And
make
if
for.
we really list all of them,
Yes.
list all the stuff, but you just sit down Monday to Friday and you write down everything what she requests. And how the hell?
Oh, yeah,
you
we can do
get
that.
to
We
your
can do
work?
that. We can do that.
You will start as an example.
We can move that, so when
We
we go
have
back to her, we can let her know.
report, impaired.
Something
Yes,
make for.
we know these reports would have to be done, but you got impaired report.
One workflow report.
You got
two-
one
two
workflow
and a
report, one this report, all these
I
things.
can
you
call all of
gotta-
them. I can see what all you get on.
Yeah, just on a given week, and mind you now, we have this on our mandate. The top 20 is once should be what, once the top 30 is once a month or
Twice a month, the
okay.
6.
Twice a month, we get the top 30. The top 20, I think we get that every quarter,
Yeah.
right? Every quarter, we get the top 20. That impaired and the workflow,
That's
something
must
see every week is get that. But that could cut down if you making sure when you work your account, make sure your workflow is done. We done been over that, it shouldn't be too much things. If you see in like one I went on, what she say, we have to look at those. The two what I have on there, they properly done sold. So if they looking at that, if Sean them or whoever looking at that, they could go in that and see that sold. So obviously something, and
I already do the
Yeah, it ain't
workflow,
coming out, it ain't
I
coming out,
already
yeah.
move the workflow. So I'm not saying.
I don't look at that way before.
No, I don't,
I don't look at that.
but you remember
But
she
she
sent
had
us
that
one.
the May 4th, she sent one say due May 4th.
Yeah, that's the one. It only have the ones, it only have a couple on there, but
I look at that one.
they comes within